We can't even plan 12 months out, said one oil executive. Another called the administration's claims laughable. Trump told Americans this week to expect higher gas prices for a little while, actually, all the way to the midterms. The men who actually pump the oil are saying it's not a little while. The floor never goes back. Here's the full story and how you can prepare right now for this.
On April 23rd, the Federal Reserve Bank of Dallas released a special update to its energy survey. 120 oil and gas companies in the Texas oil patch responded. Wellhead managers, exploration and production executives, oil field services operators. The raw comments were published on dallasfed.org for anyone to read. What they said about the next 6 months is something every American household should hear, and almost nobody covered it. Let me read you their words. Oilfield Services Executive, filed directly with the Dallas Fed. The disconnect between spot prices and midstream feasibility is widening. Extended lead times for pipeline products and significantly increased transportation costs, both exacerbated by the shipping crisis in Hormuz, have turned our 12-month projections into logistical jigsaw puzzles. The extended shipping blocks are effectively an unlegislated tariff on our infrastructure, forcing us to choose between paying a premium for domestic supply or waiting indefinitely for increasingly expensive global shipments. Unlegislated tariff, the oil industry's own words. Nobody voted on it, nobody passed it, nobody set an end date. E&P executive. Sudden rises in oil and gas prices are beneficial to our cash flow, but very problematic to the U.S. economy. As a producer, we find the short-term gains in profits certainly are not beneficial for long-term stability in our industry. The producer making money off high prices is telling the Federal Reserve those prices are bad for the economy he sells into. He can see what's forming on the other side of the windfall: demand destruction. The customer who can't afford the product eventually stops buying it. And when enough customers stop buying, the windfall becomes a trap. Another oilfield services executive. Within the oilfield services sector, the low-cost environment is starting to put companies out. We are having founders approach us to take them over. The balance sheet is drained. Manpower and machinery are depleting within the industry. Realized prices will have to rise significantly, with longer-term positive prospects for widespread investment to pick up. Founders walking into competitors' offices asking to be acquired. Balance sheets empty. Skilled workers gone. Equipment unmaintained. That's the supply side of American oil right now. Not expanding to meet the crisis, but contracting under the weight of a 3-year cost squeeze that preceded the war. Even if every geopolitical condition resolved overnight, the people and equipment needed to ramp production have already left. Someone on this channel wrote, "When oil almost doubles in weeks and stays there for months, many things start to break." 36 people agreed. That's what the insiders are describing, not the price going up, the things breaking underneath while the price stays there. The Dallas Fed asked when these executives expect traffic through the Strait of Hormuz to return to normal. 20% said May, the optimists, and we're nearly past May. 39% said August, the largest group. 26% said November. 14% said later. 4 out of 5 executives running the oil supply do not expect this to normalize before August. They're not reading headlines. They're planning payroll and ordering pipeline materials around what they actually believe. The survey also asked about the future of the strait itself. 48% said it's very likely that geopolitical events disrupt Hormuz again within 5 years. Another 38% said somewhat likely. 14% said unlikely. The strait as a reliable global trade route in the minds of the people whose businesses depend on it is finished. The $2 to $4 per barrel shipping premium most executives expect after the conflict is the permanent surcharge replacing the pre-war cost. That premium doesn't expire when the ships start moving. Now, crude pulled back after ceasefire headlines. The futures market eased. The talking heads said the worst is over. I know what the skeptic is thinking. Here's what the skeptic isn't seeing. The uncertainty index among Texas energy firms climbed to 53.7, its highest reading ever recorded. That index measures how confident executives are about the future. At its highest reading ever, they're the least confident they've ever been. And confident executives drill. Uncertain executives sit on their capital. That's why the Dallas Fed asked about production response and got the answer. More than zero, but not more than 250,000 barrels per day for 2026. 250,000 barrels against the 10 to 15 million Hormuz carried. The skeptic says prices are easing. The people who would need to produce the oil to justify that easing just told the Federal Reserve they're not going to. The Dallas Fed didn't just survey oil companies. The broader Texas Business Outlook survey collected responses from businesses across every sector. And the comments from outside the oil patch tell you how deep the fracture has already traveled.
Hey everyone, real quick jump in. Want to throw this out there. I put together 4 courses on how to make a killing in real estate as it dips down and we move into the next recession. It'll teach you economic cycles for real estate, how to deal with bear markets, and so much more. Links down below. It's one stupid low price. I'm going to keep this sale going for just a little bit longer. Now let's get back to this video.
One executive. I recently saw a chart that showed oil price shocks starting with the OPEC embargo in 1973. Every shock, 6 instances prior to 2026, resulted in a recession. It's hard for me to imagine this current conflict will sidestep a recession if it drags on longer than 6 months. 6 for 6, the executive's words, not mine. Late February to late August is 6 months. That's the timeline he's watching. An aluminum industry executive. 10% of the world's primary aluminum supply comes from the Middle East, traveling via the Strait of Hormuz. 2 primary reduction smelters were bombed by Iran, curtailing a significant portion of production. Prices should drop when the strait is fully back open, but the lost production will more than likely keep prices up somewhat. Aluminum is in every car, every building, every appliance. The smelters that were bombed take years to rebuild. The strait reopening doesn't undo the bombing. A cosmetic dentist. Any impact on us would be via its impact on the stock market and interest rates, which affect us by reducing disposable income needed to pay for cosmetics. When the energy shock reaches the point where a dentist in Texas can measure it in canceled appointments, it's reached everywhere. The money that used to fund cosmetic dental work is in the gas tank now. And one executive flagged the collision the financial press hasn't touched. We're seeing tremendous demand from AI and data centers that want to connect to the grid. If Texas power producers are spending more on gas and oil to fire the generators, it's inevitable those higher costs will be passed along. The AI boom runs on electricity generated by natural gas that just got significantly more expensive. Your household and the data center training the next language model are drawing from the same grid. One of you is going to pay more for it. I want to be direct with you about what this adds up to. 120 executives filed these responses with the Federal Reserve. The insiders drawing the recession parallel cited 6 previous oil shocks and 6 recessions with 0 exceptions. The oilfield services companies are being acquired by competitors because their balance sheets are empty. The aluminum smelters were physically destroyed. The cosmetic dentist is losing clients. The AI data center is competing for the same energy the household needs. In the production response the economy is waiting for, the drilling that's supposed to follow high prices is not coming at any meaningful scale because the people who would do the drilling told the central bank they don't trust the stability enough to invest. That's not a forecast, that's 120 filed responses. Here's what you do with it. 5 steps, all practical, all this week. Step 1. Go buy a 5-quart jug of engine oil, whatever your vehicle takes. Write the price on the receipt. Put it on your refrigerator. In 30 days, go buy the same jug at the same store. Compare the 2 receipts. That is your personal energy inflation tracker. More accurate than any CPI report, more honest than any headline. The receipt on your fridge will confirm or deny what the insiders told the Fed in real time, from your own data at your own store. Step 2, read the survey yourself. Go to dallasfed.org, research tab, surveys, energy survey. The raw executive comments are published. Every quote I read you today is on that page. Form your own opinion. Don't take my word for it. Don't take the skeptic's word for it. Read what the people running the supply said to the central bank in their own language and decide for yourself who's more credible. Step 3. Bookmark the EIA Weekly Petroleum Status Report at eia.gov. Look at distillate inventories. If they're below the 5-year average, the floor under diesel hasn't moved regardless of what crude futures did that afternoon. Inventories are the ground truth. Futures are the sentiment. When they diverge, ground truth wins. Step 4. Save every gas receipt for the next 90 days. Every one, envelope on the kitchen counter. At the end of 90 days, lay them out in order. You'll see a trend line no news broadcast will ever show you, because the news reports one price on one day and calls it a story. 90 receipts in sequence is the actual story. Step 5. Build a 90-day buffer on the household items most exposed to diesel. I covered the specific 4 in the previous video. The insider timeline gives you the planning horizon. The price you pay today on diesel-sensitive goods is lower than what you'll pay in midsummer because the surcharge is still working through the supply chain. The window between what the pump already said and what the shelf will say is still open. 5 steps. An engine oil receipt on your fridge. The Dallas Fed survey on your screen. The EIA report bookmarked. 90 days of gas receipts in an envelope. A pantry buffer built on the timeline the insiders gave the Federal Reserve. None of these cost more than 10 minutes and a few dollars. All of them put you ahead of the person waiting for the news to explain what the insiders already filed. The choice is yours. Listen to the skeptic who's watching futures bounce on a headline, or read what 120 oil executives told the central bank when nobody was supposed to be paying attention. Have a plan, because they have one, and they just showed you what it's built on.